We got short interest numbers for SoFi this week, and the levels still remain pretty high. SoFi has 186 million shares sold short, and we're going into a time where we've already had our first rate cut, and SoFi is about to report their fourth quarter of profitability. And this is a pretty impactful time, and I am of the opinion that SoFi is going to have an end of the year rally, which makes this short interest really interesting in the grand scheme of things. And in this video, I'm going to be chatting about all the specifics. Okay, so I want to cover the SoFi news for this week, starting off with the stock price. As always, if you're new to this series, consider subscribing for more SoFi specific news. In terms of the stock price, the stock closed about 2% down over the past 5 days, which is fairly insignificant because it's been mostly flat. On Monday, I made a video about Cash Coach and some of the insights that we got last week with our special guest on the SoFi Weekly podcast, and how Cash Coach has the potential to play in the SoFi wider AI strategy. And if you haven't seen that video yet, I strongly recommend it. I'll attach it at the end of this video because I think it's crucial to understanding the long-term vision for SoFi's ecosystem to serve as their competitive moat. And this is something that I've been harping on for quite a while now because I do think it is a competitive advantage that SoFi will provide relative to others in the space. You might compete in one aspect on financial services with one competitor, and you might compete on lending with another competitor. But having that ecosystem with SoFi Plus and that subscription offering, and eventually what Cash Coach offers, I think is going to be a moat that makes them sticky across everybody in that ecosystem. Starting off with some minor news pieces, on Wednesday, we got news that Apple lowered their APY on the Apple Card from 4.4% to 4.25%, and Marcus also lowered their APYs as well. And in my previous video, when I was talking about the APYs last week with regards to the Fed cut, I said how many institutions would be lowering their APYs over the coming weeks, and that's what we're exactly seeing. And the reason why is because many of them are forced to lower their APYs. I explained in that video that the rationale is also a competitive advantage for SoFi, but I think Brad highlighted it well in this post. He says, quote, "The rate cut cycle should accentuate SoFi's APY strength. First, the bank charter means lower cost of funding versus most disruptors and fintechs. Also, no sponsor bank to cater to. So a lot of these fintechs, they have sponsor banks, and essentially, when the sponsor bank wants to lower the APYs, the fintech can't really do anything about it. Number two, branchless business model and owning the tech stack means lower cost intensity than incumbents. And number three, continued balance sheet optimization means cost of capital declines. All three will embolden SoFi to lower its APY more slowly than others while maintaining a 5% NIM. And so far, we haven't seen SoFi lower their APYs since the Fed announcement. Of course, they did lower it very slightly before the Fed announcement. So we'll see what happens over the next couple of weeks. Also on Wednesday, we got some Galileo news, and it seems as though on a weekly basis, Galileo is consistently rolling out more functionality. In this press release, they highlight that Galileo secured credit with dynamic funding was released. I'll walk through some of the main pieces here in this press release and also share some of my thoughts. First of all, the press release highlights that Galileo announced the launch of secured credit with dynamic funding, built to help fintechs, banks, and other businesses address the needs of underbanked and underserved customers. This product simplifies the secured credit process, making it easier for consumers to manage their debit and their credit accounts. It's a streamlined solution which also reduces the risk for lenders by backing credit with secured deposits. The press release highlights that more than 45 million Americans are either credit unserved or underserved, and that traditional models have complexities around where customers want to use their funds. Customers face the dilemma of keeping their cash in a demand deposit account for use with their debit card or in collateral accounts used as secured credit. The behavior of dividing these funds puts consumers at a disadvantage through their credit building journey. So at a high level, what this solution does is it automates the movement of funds between accounts, which allows customers to manage all of their money in a single account for both debit and credit transactions, and eliminates the need for manual transfers between these two accounts, the collateral and the DDA accounts. Now, for businesses like banks and fintech companies, it reduces their risk because the credit is backed by the money consumers already have on deposit. So it's a win-win whereby customers can more easily build credit and businesses can offer a user-friendly service. And ultimately, it allows financial institutions and fintech companies to offer a more attractive product to consumers who care about rebuilding their financial profile or building credit in the first place. And it has a lower risk since the credit is backed by secure deposits. So overall, it just seems like a solid product offering and fits with a wider mission. It also fits with Galileo's pace of innovation. But the main piece of news that I wanted to cover this week was this short interest around SoFi. And ultimately, I just wanted to hop very quickly and make a video about it because the short interest numbers came out for the latest reporting, which was September 13th, and it showed a short interest of 186 million shares sold short for SoFi, about 17 or 18% of the shares outstanding. The short interest has remained elevated on this company for the majority of 2024. Of course, we're not at the peak level. I think we peaked at March, 209 million shares sold short, but the elevated levels are pretty much consistent since that time and until now. If you look back last year at this time, or even in January of 2024, you have almost half the short interest that you have today. It's quite drastically lower. And so there's an elevated short interest all throughout 2024. And yes, over the past 30 days, there's been a slight decline in the short interest. But again, we're at a new elevated level this year than we were last year with the short interest. And that's interesting to me because when you look at the wider picture, you have this company that's consistently executing on their numbers, and the short interest is still persisting in this high level in the teens, basically. Essentially, you have this big bet on SoFi being a depressed stock and going down even further and carrying with it a lot of risk. That's what a 17% short interest tells me, right? If I looked at a company and I knew nothing about it, but I saw that it had 17% short interest, I would assume that it's a horrible company, that it's going down, that, there's a lot of money betting against it. And for SoFi, it's true that there are a lot of people betting against it. And yet, at face value, you would think that's absolutely ridiculous because the company is doing quite well fundamentally. And on one hand, I understand that the stock is absolutely broken and disjointed from the company. And I'm not going to argue with that because management has consistently released good news and it's seldom done anything to move the stock. So in a sense, I do understand the short interest, but I think every quarter that passes, it becomes riskier and riskier to carry such a heavy amount of short interest against SoFi. I made this post on X this week, and in that post, I highlight that we're at a point right now where this company, in about a month, is going to report their fourth consecutive quarter of GAAP profitability. And we know that the criticism of many bears and many analysts is that SoFi is still an unprofitable company. And the reason why they think this is because they're looking from a trailing 12-month perspective. And if you look from a trailing 12-month perspective, you're going to see this massive drawdown of $266 million back in September of 2023. So over the last 12 months, SoFi doesn't look profitable. But if you look every single quarter, starting in December to March to June of 2024, every single quarter has been profitable. And now, over the next 30 days, they're going to lock in that fourth quarter of profitability so that when you look from a trailing 12-month perspective, it's going to be a profitable company. And this, I think, is going to assuage a lot of the analysts who are still looking at SoFi as an unprofitable company. In my post, I put the institutional ownership for SoFi, and we can see from the institutional ownership that there has been a steady accumulation in SoFi stock over the past year, whereby institutions have been consistently gobbling up shares of this company. And this entire accumulation is happening in the background while the short interest is very elevated. Like if you look at those two things side by side, you can see that short interest is elevated while institutional ownership keeps going up and up and up every month. And so what I argue in the post is, I simply put these facts together. You have heavy institutional accumulation going back all year long. You have 18% short interest, and you have a stock price that remains fairly depressed from short sellers. I mean, it's down 17% year to date. Analysts are still viewing this company as unprofitable on a 12-month trailing basis. It's very possible that many of these shorts are also large institutions, and it's very possible that it's the same large institutions who have a short on the company who are also building a position in the company. This is complete speculation, by the way. It's also possible that some of these analysts from these same institutions are putting out low price targets. Now, I won't dive deeper into that speculation to say that something fishy is going on, but in that post, I highlight that there are some institutions out there that can't buy until you have 4 quarters of profitability. They have minimum requirements for market cap. A lot of people in the comments were saying that a lot of institutions can't buy under the $10 range. And I'm not sure about that, but I do know that different institutions have different requirements. For example, like a pension fund will have a stricter mandate on focusing on risk mitigation. They would avoid unprofitable companies because they have some type of moral responsibility. Certain mutual funds or ETFs especially would have similar stipulations. There is this perception that profitability is a prerequisite to deeming a company a quality investment. And to some degree, I understand that perspective, right? Because you want the investments you make to be compounders and not money losers. But essentially what I argue in this post is that once you have that final quarter of profitability, this will be a profitable company on a quarterly basis and on a trailing 12-month basis. In that post, I say that the institutional accumulation that we're seeing here that's been going on over the past several months from hedge funds and others who are buying SoFi stock in anticipation of that full year profitability. And I think once you do get that profitability, you're also going to get with it a large buying pressure because there's no longer any major bear case towards this company. It's no longer an unprofitable company, right? And you're heading into a macro environment that's very favorable for this company. It's going to thrive in a low interest rate environment, in a falling interest rate environment, which we're getting right now. Yes, I could be overly optimistic, and I have been accused of being overly optimistic in the past, rightfully so. But I do think that when you put all these factors together, the high short interest, the heavy institutional accumulation, the fact that it's macro beneficial for this company to be in this environment where rates are going to keep falling and falling and falling every couple of months, and the fact that this company is going to be seen as a profitable company over a 12-month period, I do think that you're no longer having a lot of these bearish or downwards pressures put on by the analysts, by the shorts, and by these institutions. I think that once that happens, you can get a re-rating from analysts. I think that you might get a rally from more accumulation, and that rally would lead to more price discovery, and that would hit everybody's market screener, which forces then people to revisit this company that maybe they haven't seen financially in several quarters and look at the numbers. And I think ultimately, at a high level, this is how stocks get re rated by the market. They get forgotten by the market for a while. Meanwhile, they're still executing. And then when the market comes back to them for whatever catalyst, whatever spark to light that rally, it forces a re rating in the stock. And what ends up happening is you have this massive breakout. Ultimately, I think that will eventually happen. I mean, my bet would be that it would happen before the end of the year, that SoFi would have a strong rally going into the end of the year because all of the negative catalysts at that point have been fairly handled and there's no real bear cases for this company. But definitely, if it doesn't happen at the end of the year, it'll happen in 2025 because you have a macro tailwind for the business. And the business will be executing to such a degree on the back of those tailwinds that it just becomes impossible to ignore by the market because they're so far and beyond beating any analyst expectations out there from a fundamental perspective. And so I think that you can have a very, very nice couple of months going into the end of the year for SoFi after the earnings report. We're going to see what ends up happening over the next couple of months. But I think this company is at a point right now where we're approaching the other side of it. We went through these tough times, these macro headwinds, and now we're coming at a time where you can see the light at the end of the tunnel. You have tailwinds on a macro perspective, you have 4 quarters of profitability, and you have steady accumulation from institutions. Once those shorts cover, once those analysts start re-rating the stock, I think that's when you get a real surge in the stock price. Of course, you can take that as hopium. You can take that as a prediction or however you will. I'm curious to hear your thoughts, so please let me know in the comments. But I do think that there is a possibility of that happening, and even if it doesn't happen this quarter, it's going to happen the following quarter because at some point or another, this stock keeps executing, and if it keeps executing, it becomes impossible to ignore by the market. So at a high level, either way, I'm not too concerned because this is a long-term holding for me. Anyways, we'll see what happens. Thank you so much for watching. I appreciate it, and I'll see you in the next one.